I want to welcome you all to today's webinar on financial mastery and retirement here at Lacers Well. Our goal is to enhance the quality of your life and retirement by providing you with resources and activities that promote optimal health and wellness. Our Lacers Well program is based on 5 elements of well-being, which is purpose, social engagement, finances, health, and community. So today we focus on finances. This is a 2-part seminar, and we'll cover information today, as well as finish up remainder of the information on next Thursday, the 14th. So we're happy you could join us for today's webinar on financial mastery. So I'll introduce our speaker, but today he is an experienced financial services educator at Foursquare Financial Literacy Partners. He has more than 33 years of experience in financial planning, insurance, and risk management, working with Cambridge Financial Partners. And prior to that, he was a chief marketing executive at AXA Advisors located in Irvine and Los Angeles, California. He was a Division I tennis player at UCLA and UC Irvine. Rob obtained his bachelor's of mathematics degree with emphasis in probability and statistics from the University of California, Irvine. He and his wife, Joanna, have 3 children, Katie, Maddie, and Jonathan, and make their home in Newport Beach, California. In his free time, he enjoys spending time with his family, playing tennis, and working on restoring vintage cars. So I'll now give it over to Rob.
For that introduction, a lot of history there. I'm an LA boy. Rob, don't hold it against me. It's not we're going to talk about your retirement money. So don't hold that against me. Not a good name to have, but what I'll do is give you hopefully some good stuff. I've been fortunate enough to really spend most of my career working with public employees. Goes back early in my career, I was told, I'm going to talk a lot about conventional wisdom, and I was told early in my career, don't talk to public employees because they're already taken care of. Conventional wisdom or views from the outside were that everything was taken care of. So in my peanut brain, I said, oh my God, if that's what everybody thinks, that means that nobody's talking to you guys. And so I've spent most of my career working with nonprofits, public school teachers, state employees, federal employees, municipal employees. And as part of the process, about a decade ago, we created Foursquare as an education company. There's no product that's talked about here. It's a pure education session that we'll be going through. And we created Foursquare, and I've been fortunate enough to work with LA City with the police and fire pension, which is separate from yours, as an educator for the last decade. So I got a good idea at how there's a lot of overlap in how your systems work. So there's a lot that we'll go through today, and not everything is for everybody, but I promise you there will be something for somebody. And I know that you're all on for different reasons. And you made an investment in your time this morning, so I want to make sure you get a return on it. And I know that there's some variations in the folks that are on this presentation this morning. Some of you might be just retired. There may be even some that have just retired just recently or almost retired. And there could be some that are retiring or have been retired for quite a while. So I'm going to try to address different issues or topics in the areas that might address the different groups, whether it's recent or long-term retired. So I'm going to switch my screen there and make sure it comes through okay. Just a quick disclosure, we always have to have the lawyers involved here, but this is not an endorsement of me or my firm or anything. I'm nothing more than being authorized to present this to you. And all the material I provide to you that, you may have your own financial advisor, you've got the Lacers staff, you've got your benefits staff that works for Lacers. A lot of the things that we go through, if there's any questions, it's really going to be they're going to be the rule in the end on this. So we want to make sure that if there's any discrepancy that we go to them for the final ruling on how things would work for you. Although there shouldn't be much discrepancy, we're hoping if we do this right. We did a little bit of this. What are you here for? I know there's a little bit, many of you are in here for different reasons. I want to make sure that you get a return on your investment in time. That's my goal today. I'm going to give you a lot of information that's very generic in nature because it's difficult I see that we've got a lot of people on the line here now. It's very difficult without your individual knowledge to really give you what I would call advice. But what I can do is make sure that should you have questions, we'll arm you properly to go back to the Lacer staff, or to go back to your financial advisor, or go back to an accounting professional or a legal professional to help you get through whatever the topic may be. This is our topics today that are in bold, and then our part 2 will be on July 14th, same time. Today, we're just going to go through really the financial concepts of what we operate from at Foursquare, and that's money is not always math. Our job is to help you understand how money flows, how paychecks flow, how things are taxed, and what we want to try to do is help you create the retirement paycheck that makes it comfortable for you to enjoy this last phase of your life, which is retirement. And so I'm going to start with going back in time. We're going to talk a little bit about, we're going to go back to the work paycheck, which may be current for some people, but long past for a lot of you. But the reason why is that our goal in questions, really the main 2 questions we get from people about retirement is, number 1, am I going to be okay? I think we just distill it down to the simplest thing. Am I going to be okay? And that's usually, well, we don't know. We need to create a goal for you about being okay. Am I going to be comfortable? And the second one is going to be, am I going to run out of money? And we're going to address both of those today. And the assumption that we make, am I going to be okay, is that if we could help you take the pieces of your retirement and put them together to create a paycheck for you, if we could get you to 100% of the take-home pay that you had back when you were working, would you be okay? And overwhelmingly, we have heads nod that say, you know, we will be okay if you can show us how to get to 100%. So my goal is to take these pieces of income for you, put them together, and see how together we can make a paycheck that gets you to 100% of what was your take-home pay. And we're going to do that first by just briefly looking at the work paycheck and comparing it to a retirement paycheck. And then we're going to include Lacer's pension, Social Security for those of you that have it. That could be a big portion of your income, but you got some challenges in collecting Social Security working for the city of LA that did not pay into it in many cases. And then you've got your money that you saved in Deferred Comp. We're going to talk a little bit about debt management. And debt management is really important because your retirement income is about cash flow. And cash flow, that's your work paycheck now in retirement. And if we can eliminate some debt or get creative with our debt, or maybe even create tax deductible debt, that it can help us in our cash flow. Saving $200 a month in debt and not making a financial institution wealthy is money back in your pocket that you can either plug into your lifestyle and enjoy more, or you could save. And then we're going to talk about that if you do have other employment and you do want to integrate in Social Security, we do have some challenges with that we want to make aware. And then we'll terminate the conversation today, and we'll pick it up on the 14th, where we're going to talk about federal and state taxes. We're going to talk about integration of healthcare in your retiree health plans and how important that is. And then we're going to talk about estate planning. And estate planning is not about having wealth that we're passing on to the next generation. Estate planning is getting your stuff where you want it to go when you're no longer here. And then we're going to put it all together and close some questions. So that's our agenda for today and for next week. So Elijah and Stephanie have already taken through a bunch of housekeeping issues. We're being recorded. We got the chat box, which I'm away from my normal presentation desk. I'm in Colorado right now, and so I'm working on my laptop, so I don't have multiple screens to work on. So I'm gonna have to toggle in and out for the chat box. So be patient with me, but I will get to the chat. I'll double check them, and this presentation will be made available back for you by Lacers. We'll have some summaries at the end of each section, and then let us know how we did. This is the second time that I'll be working with Lacers in this presentation. I hope to do it many, many more times. So the things that drive us in our philosophies here, conventional wisdom, what gets us into trouble is not what we don't know. It's what we don't know that just ain't so. Why are there interstate highways in Hawaii? Why is the black box orange? You may have been told things over your lifetime by mom or dad or spouse or partner or friend, back at work in the break room. You should do this, and we call that well-intentioned advice. Well-intentioned advice usually comes out of that something worked out well for somebody, and they want to share it with you and help you out. Good advice is going to be advice that is directed just to your particular situation. And so through the course of today in the chat box, if it does come up on some of our topics, put it in there. Hey, I've heard, or somebody had told us that we should, or is it better that we should do this? And let's check on conventional wisdom and see, and question a little bit and see if it would apply to you. So money is not math is about identifying eroding factors or places where we're losing wealth, whether we're working or whether we're in retirement. But this is what drives us here. And anything about financial planning is always about getting you from here to there. And what we do then is we help you connect those dots. I have an 10-year-old daughter, and I want her to go to a state school in 10 years, or 8 years, sorry, and I need $10,000 a year. Well, where are you now? And let's create that goal, and let's see how we can connect those dots. Or I want to retire on 100% of my income and at age 55. Or I need to buy a house in 5 years, and I need $50,000 that I need to save in order to do so. So we help you connect those dots. And connecting those dots, we have an X and a Y axis here. On an X axis would be our time, and on the Y would be our dollars. And so we use time, money, and then return on your money to try to estimate if we can make those dots connect. And a lot of times those dots don't connect based on what we're doing. So we're going to come back to you and say, oh my gosh, those dots don't connect. So what we need is more time. And you're going to say, well, I can't have more time for whatever the reason may be. And we can always solve any of these issues by digging deeper into your pocketbook, but that digs into your lifestyle. And that's not always so nice either. So we can always then add, what if we could stress your money out more and add to your return? Instead of getting 6%, if you got 8% on return on your money, these dots would connect. And in doing so, what we end up doing is adding a level of risk to this equation. And hope begins to enter into the equation that we hope that the market goes the right way until I retire, or until the point in time comes. So we enter into a little bit of we enter into more risk is what we end up entering into. So now we could have a fluctuating, we could overshoot what we need, but we could also undershoot depending on the timing on whatever happens in the underlying investments. So the other thing too is money doesn't grow exponentially or straight line, it grows exponentially. And compounding the money is what is your best friend. Keeping money on a timeline and invested is your best friend. Interest earning interest, or investment earning investment. The compounding of money is so important. And there's a rule out there called the rule of 72. The rule of 72 is explained about how you can estimate how a lump sum of money, not a amount that you're putting away on a biweekly basis or a monthly basis, but if I had a lump sum of money like $100,000, for example, and it's earning a rate of, and it does exist out there, 8%, how long will it take that 100,000 to grow to 200,000? And so what you do is you take the number 72 and you divide 8 into it, which is the interest rate, and you get 9. That means that $100,000 will be $200,000 in 9 years at 8%. And then it'll be $400,000 in another 9 years. And it'll be $800,000 in another 9 years. And it'll be $1.6 million in another 9 years. And you can see the power of that compounding just being the same interest rate, but look at the dollar amount. 100 grows to 200, that's 100,000. 200 grows to 400, that's 200,000. 400 grows to 8, that's 400,000. 8 grows to $1.6 million, that's 800,000 for the same time period. That old saying that the first million is the hardest really is the truth. Once we can get to that compounding afterwards is what really is our best friend. So what we want to do is keep our wealth and your earnings and your savings as long as we can on that timeline and not have a lot of eroding factors hit it that are going to take away the opportunity for that money to grow. And so since this has a little bit of a shape of a hull of a ship here, I'm going to make a sailing analogy, is that a lot of times what we're trying to do is to get you into retirement port by blowing more wind into your sail. But just like the wind, the market is unpredictable too. And so rather than focus on the wind, let's focus on the hull of your ship and all the things that you're putting in it, and make sure that there's no holes in your boat. And let's plug those holes in your boat. And through our education program, going back to when people are working all the way to retirement, we can expose people to things that can cost you hundreds of thousands of dollars of use, control, and enjoyment of money in retirement. So I understand life happens and, things change. There are things that we can control, though. We can control our debt and loans and interest charges. We can control by saving that money that it stays. A lost opportunity cost is what stays on our timeline and is able to be invested or to be saved or even spent and enjoyed rather than just wasted. And for the people that are working, there was a deduction area of your pay stub, and it may have that on your retirement pay stub too, where you brought benefits into retirement that maybe you don't need anymore. And taking a look at those are areas that people are, just as they grew through all the years of employment, they didn't realize that was still coming out of their check. We can't control inflation or the stock market or planned obsolescence is when things wear out, or lawsuits or interest rate fluctuations or divorce or taxes, but we can impact them a little bit by understanding them. So we're going to give you a little bit of information around those that might be able to help you, that could impact you. So our first section here is going to be getting to 100% of your take-home pay. And that's going to include, I think, the three pieces that will be for people will be Lacer's pension, it'll be Social Security, and deferred compensation, the income from your deferred compensation. And so we begin with the end in mind. How can we make these three pieces work together to get us 100% of our paycheck and all the way starting from when we're getting close to retirement, at retirement, and then down the mountain, which is our retirement years. So we're going to hit these three together, plus we're going to talk about eliminating some consumer debt in this section. Now, the reason why we have the picture of Mount Everest up is that if we were on this phone call right now and together planning to climb Mount Everest, our goal would not just be to get to the top of the mountain. Our goal would be get down the mountain and get home safely. And the same analogy can be applied to our retirement planning. A lot of folks will plan, they get to the top of the mountain, they will plant that flag and they say, oh, now I'm retired, now what? And then they'll make some other decisions that those decisions could have been changed and altered to their advantage if it had been brought up and thought about while they were coming up the mountain. So we need to make it one continuous journey, not one where we're up the mountain, planting the flag, then what do? Then we come down the mountain. We're gonna make decisions and position things so that we're going to begin with the end in mind. I need 100% of my take-home pay for the entire amount of my retirement, and I'd like to leave over or have leftovers for X, children, etc. So how do we coordinate these sources of retirement income? For a lot of you, I'm going to go back in time if you've already been retired. And some of you the screen may be small, so I think I can expand my screen a little bit here, make it a little bit bigger. And this is software that we have, which is payroll software. And what I'm just showing you here is that while you were working, you were paid biweekly. And you say, if this is an example of a biweekly paycheck here, this is not going to let me move it up. There we go. I would have certain things that would come out of my check. My gross paycheck was $25.95, as you can see maybe up here, $25.95 per pay period. And I had things come out pre-tax for certain items. I was putting into my deferred comp a certain amount. I had a pension contribution that I was making that was coming out of my check. Then I paid federal, state, Medicare, and then I had other after-tax deductions from my maybe from a CIPSA or my union dues or things like that. But you were paid biweekly, and you have to convert that over to monthly, which is this other side. And why monthly? Because in retirement, you're paid monthly. And if you want to compare the two together, we've got to compare a monthly to a monthly average paycheck while you're working to a monthly retirement paycheck. So if we took this out and averaged out monthly, our amount that we would gross in the course of an average month would be $56.22. And then we'd have those same deductions come out, but they've been adjusted to monthly. And so we would see that we're really living on average $35.27.44. That's the exact number when when we were working. And that's what we were paying our bills on. That was our take home. And I hear from a lot of people, but I'm retiring at 60% or 70% or 45% or whatever it may be. I can't take a 50% haircut or a 40% haircut. Well, that's your top line. We got to compare the bottom lines, not the top lines. So this next slide just shows, and this is I hijacked from your Lacers site. This is just showing a great example of things that come out of your check while you're working that don't come out when you're retired. A lot of those, the retirement, healthcare, defrayals, all types of deferred compensation, parking, dues. These are all things that are going to disappear from your retirement and won't be deducted from your retirement paycheck. So now that you're retired, these things, your pension, deferred comp, Medicare, health, defrayal, dues, city parking, these things all disappear. So on the left here panel, what we have is that same monthly work paycheck, and on the right panel, what we have is a monthly paycheck in retirement. And this would be about a 50% retirement from Lacers. So that 50% retirement would begin with expand that screen again, $2,750 in pension. And we would have to add an additional $1,250 of income in there from some source, Social Security, deferred compensation, additional employment, in order to get ourselves to 100% of our take-home pay. But we don't have these things coming out of our check anymore. So we would have to have a total taxable of $4,000 per month in retirement, which would be $2,750 being pension and $1,250 being from another source. We'd pay our federal and state taxes only. We'd have some deductions come out in retirement for health insurance, and then we would be back to our 100% of our take-home pay, approximately $3,500 and change. Now, example number 2 would be around a 55% Lacers pension. And again, same, the work paycheck there on the left. On the right would be the 55%. So we're seeing a little higher pension amount. So therefore, we have a little less that we have to put in to get us to 100% of that take-home pay, which is the same gross $4,000. We pay our state, our federal, our health insurance comes out, and we're at the same $3,500 a month take-home pay. And this would be a 2/3 pension here, about 66%. And if we had a 66% pension, we can see that we only are short $250 a month in order to get us to 100% of our take-home pay of $3,500 and change. So in this example that I showed you, and everybody's going to be a little bit different, but a lot of you that are on the line may have experienced, you know what, I got a pay raise when I retired, and I didn't realize that was going to happen. We see that happen quite often. So I'm going to take a second here, escape out, and I'm going to look at the chat box. I don't see anything that's come in. I think we're good here. Okay. Questions you can put in the chat box. This is just kind of setting the table here. Let me read. My screen should be full again now for you.
It is.
Okay. So after reviewing your take-home pay, then what we want to do is, you know, that $250 that you're short, or that $750 or that $1,250, you don't necessarily have to have additional income to fill that gap. But what if first what we did is we looked at our debt and said, maybe we don't like looking at it, but there's ways that you can handle your debt that if we could eliminate or minimize could really help you in cash flow. And being in Southern California, probably one of the things that we see the most is that homes are not paid off when we go into retirement. And if your home is paid off, God bless you. That's great. But our home is probably one of our biggest cash flow items, servicing that mortgage. So if we can save some way in cash flow on that mortgage, whether it's getting to a lower interest rate, and mind you, I'm aware that if you were to refinance prior to retirement or in retirement, you got another 15 or 30 years that you got that mortgage. I understand that debt is not going to be eliminated, but the cash flow might be reduced, which will allow you to live. And by doing so might increase your tax deductions for you and by increasing your tax deductions will decrease the amount of tax that you owe. So the combination of a lower mortgage and a higher deduction could really help you in cash flow in retirement. And one of the things that I don't have on the slide here, because I just like to talk about it, when I'm working with the police and fire and talking to them about this on this slide, one of the things we see in Southern California a lot on our mortgages is a thing called PMI, property mortgage insurance, which is what a lender requires us to have to protect them if we were to default on the mortgage because we didn't put enough down on the home. And that'll be lender specific. But I've seen PMI as high as $900, $860 a month inside some of these sessions. Well, it was a record I've ever seen, almost $900 a month, which is close to $10,000 a year. And if we could just eliminate that PMI, that alone would increase your spendable income for your lifestyle or savings by close to $10,000 a year. That's a big number. So if you do have PMI and you still are servicing that leading into retirement or at retirement, our home values have gone up a ton. Maybe we could get our lenders to reduce it, eliminate it, or not reduce it, they'll eliminate it, but they may require you to refinance it out of it. So you'd have to go through the whole refi problem, the old refi process. So, but that could be an immediate way to increase some cash flow. Also by decreasing that, that can help a ton. And for those that are on the phone that are veterans, you know, the VA has a very, very nice loan out there where literally we're a military family, for having a zero down and within the constraints of the loans, you can have no PMI to service as a VA loan. So that might be one way. To give you a great example, life example, I had a female law enforcement officer about 5 years ago come up and corner me and said, "You've nailed this. Cash flow is what I'm worried about in retirement. And my biggest problem in retirement cash flow is my mortgage." Her mortgage was about $1,700 a month. And I said, "Well, how much longer do you have on that mortgage?" And if I recall right, it was a little while ago, but it was about 10 years. And I said, "Well, have you ever thought about refinancing that mortgage?" And she said, "Well, why would I do that? I only have 10 years left on it." I said, "I know, but the cash flow, if you were to refinance it," and she only had a little over $100,000 left on that loan, maybe it was less than 10 years then it would, 100,000 refinance at the time, we just did a quick calculation, would be under $500 a month. That would give you some incredible cash flow increase so that you could afford to retire. And so she was able to do so. She actually took some money out too. And it turned out for her first cost of living increase in retirement increased her payment, her retirement payment in such a way that it covered her new mortgage, which was under $500 a month. And she was able to live. So this is about being able to live and have the cash flow to retire and be comfortable. The other two debts that we see that we want to help people get eliminated, we'll start at the bottom, is credit card, and then we've got the auto. And the credit card one, that's one that we all understand. It's one that hurts if we've got that. The only thing I can tell you is check your interest rates. We had a school teacher that we did this exact exercise with. This is an old story. If you've been on before, you're going to hear me go over these stories again and again because they're my best ones. And her take-home pay, she was going to be about $1,500 a month short in take-home pay to get to 100% of income, and of what not income, but take-home pay, what she was going to live on. And we looked at her debt, and she had a mortgage and she had a credit card. And the mortgage was high. It was 6.5% in a market where environment was maybe 4 or 4.25 at the time. But she couldn't refinance. She had tried because her credit card had $30,000 outstanding on it. So her debt to income ratio was hurting her there. The problem was that she was paying 29% on that $30,000 credit card. And she didn't like that she had that debt, and she paid what she could. And she put her in a drawer, and she never realized that 1 month years ago she was late, and her interest rate went from somewhere like 13.5 up to 29% as a penalty for being late on that 1 month. And so she's paying $9,000 a year, $9,000 a year just to stay at $30,000 in debt. And so we want to get rid of that $9,000 in interest. So we were able to borrow against her equivalent of a deferred comp. She had 5 years left before she was going to retire. It was a 5-year loan. And if we turned her contribution to her deferred comp, or her what would be her deferred comp, into a loan repayment, so we lost some tax deduction. But cash flow wise, she wasn't really hurt at all. In fact, we picked up a lot of cash flow because we got rid of $9,000 of interest that she was servicing. Now, when she borrowed from her retirement plan, it's not reported to the credit agencies. So she was able to then, her debt to income ratio looked real good, and she refinanced her home, and she saved another $450 a month in interest on her home. She was overall almost $14,000 of interest that we got rid of just rearranging furniture in her living room. So your credit cards, checking those minimum payments, maybe paying a little bit more, checking your interest rates, transferring them on low interest cards, paying your highest interest card off first, and then taking that same payment and applying it to your next card and the next card. Getting rid of any of that debt is income to you in the end. So don't minimize what can be done and the impact it can have on your cash flow. It's wonderful. So picking up in the example where that person was short $250 a month in take-home pay to getting them to 100% of their take-home in retirement, if we could eliminate a $250 debt, we're there. You don't even have to worry about any of the other sources of income. That just gets you even higher in your income during retirement. Now, the last piece we talk a lot about is auto, and auto is not something that we really get to deduct. And whether you're leasing or whether you're buying, because you were an employee of the city and now you're retired, if you don't have any occupation or anything that you're working or any business that you have, really your auto is nothing more than a debt, the insurance, the gas, the maintenance, et cetera, but we need it in order to get around. But you might be able to turn something that you're doing in retirement, I'll call it a hobby, into tools, turning toys into tools. My next door neighbor, a couple doors down, retired from the city of Costa Mesa, and all the time that he was working as an employee of the city, his garage was filled with woodworking equipment. He loved building furniture. That's what he did. And when he retired, he was going to do the same thing. He was going to build furniture. Well, he got a hold of an accountant got a hold of him, actually, a good accountant, and said, look, you're spending all this money on furniture, on equipment, on electricity. Why don't we turn your hobby into a legitimate business? And in doing so, he tore his garage down to the studs and brought in a separate electrical panel. So all the electricity that comes into his garage now is a business expense. He now deducts the space of his garage as a legitimate business. He also has equipment that he depreciates, and all the wood and the screws and the glue and everything and the tools that he has that he purchases, he deducts. Furthermore, while I have this on the auto, he's got an Ford 150 truck, and he puts a magnetic sticker on the side of his truck. And the truck that he was going to have anyways, that he makes a monthly payment on, that he's now paying $6.50 a gallon of gas on, that he has insurance and maintenance and tires, well, that truck in part or in full can be a deductible item for him. So you might be able to take things that you're doing in retirement, turn your toys into tools. And where I really learned this was from an old friend who did a lot of work with NASCAR over his career. And one night we were having dinner, and when I say NASCAR, the suppliers, the people, the engineers, all the different teams, he would go out and to all 36 NASCAR races, and these people were all clients of his, all the way down from the owners, all the way down to the people that made stuff for NASCAR. And we were having dinner one night, and I asked him what toys he had in his garage. He always had the motorcycles and hot rods, and he slams down his fork. He says, I don't have toys, I got tools. Tools are tax deductible. So I'll never forget that line. So if you have a way to turn your toys into tools or your hobbies into a legitimate business, that can help you out income-wise too, because by decreasing your tax liability, that money goes back into your pocket. So part one is just that cash flow, understanding how those pieces flow in and how we can really understand what we're trying to get to at a net income and how to impact that first by eliminating debt. Then once we eliminate debt, we got the next pieces that can flow in. The second piece is going to be Social Security that I'm going to go through. And the third piece will then be your deferred compensation. And I think a lot of you want to hear about that because you've been looking at your statements the last 6 months, and they look a little different going the opposite way than they did for a lot of the years that you were in. So before I go in, I'm going to check real quick for anything in the chat box. And I don't have any messages that have come in. So I will go back to the presentation. Now, Social Security is something that you may have paid into. For a lot of you that are on the line, you may not have paid into it at all, or maybe you got a very small benefit. But there still is time if you were to work post-retirement that you could build a Social Security record and create some retirement income from Social Security. But there's some uniqueness around your circumstances because you're being a city employee and receiving a pension by which you did not pay into Social Security can affect your Social Security record. And this is one of the most least understood benefits by, I think, the consumers and by us being the financial professionals out in the world. And so we've taken some time to understand Social Security a little bit better, and we have workshops that are just on Social Security to help people make some decisions. But when I ask most people, how do you think Social Security works? In my industry and in your shoes, this is usually the face that I get. And we just have kind of paid into it and thought, well, maybe we're going to get something. I'm not really sure how it works. So I'm going to go through some of the basics and some of the things that we can use to plan around it. But then I'm going to give you bad news at the end that some of the benefits I'm going to go through that you have by qualifying for Social Security, they will get reduced or even possibly eliminated because of you receiving a pension from the city of Los Angeles. So some basics on this: you do not pay into Social Security as a city employee, but you may have contributed through outside employment. And in order to collect it and qualify for it, you need the 40 credits that are necessary. And if you haven't quite got to the 40 credits, one credit is $1,510 in earnings for 2022. And if you made $6,000, just over, in 2022, you would get the max 4 credits for the year. If you're short credits, you can still go back and work and be able to make those credits to fully qualify for a Social Security benefit. Now, the way that Social Security works, it's not really a big mystery, but they just use different numbers and different formulas, but it's just like your LACERS pension. It's a function of your age, your years of service, and your income, just like your LACERS was calculated. So, but it's a little bit of a different formula. You're eligible for 100% of that formula when you hit your full retirement age. And full retirement age for most people on this line would be age 67. If you want to receive Social Security credit or income prior to 67, then you get decreased benefits for claiming prior to that full retirement age. But you also get rewarded for leaving it in longer and get increased benefits for claiming after. And I'll show you a nice little slide that I hijacked from JP Morgan that shows how that works. However, your benefits that you receive from Social Security are subject to the Windfall Act, which could reduce those benefits that I'll explain to you. And I'll show you how the Windfall Act works. I'm not going to go through the math with you necessarily, because I think I'd make your head explode across the internet, and I'll put you to sleep on it. But for many of you, you could qualify for Social Security not on your record, but on somebody else's record, like a spouse. However, those benefits can also be offset by another act called Government Pension Offset. So at the end of this section, I'm going to spend some time on windfall and government pension offset. Another question is, you don't outlive your Social Security benefits. They pass when you pass. And I will always urge you to visit your local office. There's so many very good people who know their craft there at the administration. We do these workshops in the federal market space with Social Security Administration. I can tell you they have people that are 30, 35, 40 years, and they've seen everything, done everything. Your local office, just set up an appointment ahead of time, and you'll be able to go down and give them your unique experience, and they'll be able to help you. They won't ever tell you what to do, but they'll tell you what you can do. So just with all the things that Social Security does, common topics around that I think surround around this are understanding the workers' benefits. Okay, that's your benefits based on your employment, but those are going to be offset by the Windfall Act. Understanding spousal benefits, but those are going to be impacted by another act called Government Pension Offset. Delaying benefits, how that exactly works. How, if I take it early, how does it decrease it? If I delay and wait longer, how long, how much more do they increase? And then we're going to talk a little bit about Social Security survivor benefits, because they have got survivor benefits too, but they're also offset by the Government Pension Offset. So we've got some things around here that these rules dig in and kind of erode your benefit or could eliminate them entirely. So Social Security offers many distinct types of benefits for retired workers. But for discussion today, there's the retired worker benefit, there's the spousal benefit, the survivor benefit, and we'll briefly talk about older parent guardian benefits because we're seeing a lot of that happening out there. So let's start with the retired worker benefit. Retired worker benefit is what you earn based on your own earnings. So let's take me for an example. I'm not going to be a city employee. I'm just going to be a regular old non-public employee. And it comes time for me to retire, and I'm getting $2,000 a month from Social Security. Now, my wife, we decided early on in our career that she wasn't going to work, and she had a record. She's qualified for Social Security. And at her retirement age, we'll call her full retirement age 67, and we'll assume that we're the same age. So I take my Social Security at 67, and I get $2,000 a month. And her Social Security at age 67 is $450 a month because she's put in less time and less earnings into the system, just like any other pension. Well, when I retire and I file my record, my wife, when she becomes eligible or at that age that she wants to, she can then apply for her Social Security. And she'll have a choice between her record of $450 a month or a spousal record, which is up to half of my benefit, which could be up to $1,000 a month. So she would probably take the spousal benefit. So I would get $2,000 a month and she would get $1,000 a month. And together we get $3,000 a month while we are in retirement. So that's how my retired worker and my spousal benefit works. Now, we go through time and we're bopping along in retirement, and our Social Security will increase as we're retired with what they call a cost of living. It'll increase every January if there's a cost of living that's awarded in November of every year. And we get that increase, and now we're out in retirement further, and I'm getting $3,000 a month, and she's getting $1,500. And bam, I pass away and I check into my wooden pajamas. What does my wife get? Well, she gets survivor benefits at that point. And the survivor benefit for Social Security for her is going to be the greater of the two benefits. My benefit was $3,000 and hers was $1,500. So she's going to get a $3,000 benefit, which will be broken into two pieces: her benefit and then a spousal benefit. I'm sorry, a survivor benefit of $1,500 to give her $3,000 a month. So the opposite way, that if we bump through retirement and I'm getting $3,000 and she gets $1,500 and she passes away, so she checks out into the next lifetime, then I get the greater of the two. I was getting my $3,000, she receives $1,500. Boom, I get nothing. I get the greater of the two. Now, I'm going to talk about one of the benefits here that could affect your survivor benefits. And I'm going to give an example now where I get $2,000 a month and my wife gets nothing from Social Security, but she's a city employee and she gets a $4,000 a month pension from Lacers. So I'm not a city employee, but my wife was. So I'm getting $2,000 a month and my wife is getting $4,000 from Lacers. So my wife has the ability to file against my record, just like I said before, for the spousal benefit. And she can get the greater of her record, which is $0, or half of my record, which is $1,000 a month. So, but that doesn't happen because she is now being a city employee and receiving the government pension. She has what's called government pension offset. And government pension offset says this: it's a formula that says she's going to take 2/3 of my benefit. Oh, I'm sorry, 2/3 of her benefit. She's making $4,000 a month, and 2/3 of that would be about $2,500 a month. So $2,500 a month. Her spousal benefit from Social Security would only be $1,000 a month. She gets the greater of the two, or the difference. Well, her $2,500 is greater than the $1,000 she would get from Social Security, so she's not going to get any benefit on the spousal benefit from Social Security because of that government pension offset. Same thing would happen on survivor benefits. I pass away, that money's coming in, I'm getting $3,000 a month. My wife's Lacer's pension has gone up to $6,000 a month with cost of living over the years. 2/3 of $6,000 a month is $4,000. My Social Security was $3,000. Her $4,000 was greater than my $3,000. She doesn't get anything in a survivor benefit. So government pension offset could eliminate the ability for you on the line here to get a spousal benefit or a survivor benefit from your spouses or domestic partners in Social Security. So that first benefit is that government pension offset could eliminate it altogether. Now, I'm going to talk about the Windfall Act in a second. That affects yours, but let's talk about first, though, how a Social Security benefit, a retired worker benefit works from when you're eligible to when you reach your full retirement age to then reach your full retirement age. But before I do that, I may have some questions that come in, so I'm going to double check this real quick. I have to escape this, and I don't see any questions, so we are still good. Got a shy crowd today.
They'll get there.
We will. I'm sharing my full screen again, should come up.
Yep, looking good.
Right. So this I hijacked from JP Morgan. It's a nice little depiction of how this works. I'm going to expand my screen a little bit for you. We're going to look at the bottom line here. So let's say my benefit, again, your Social Security is just like your pension. Age, years of service, and income is how they create my benefit at my full retirement age 67. My benefit at age 67, let's say, is $2,000 a month. Okay, well, that's what it'll be out then. But what if I take it early? And I can take it as early as age 62. Well, if I take it when I become first eligible, I only get 70% of that age 67 benefit, or 70% of $2,000 a month is going to be $1,400 a month. So if I take it here at age 62, I'm only going to get $1,400 a month. So let's say it another way. For every year that I delay beyond age 62 in the Social Security system, my benefit, and this is the retired worker benefit now, this is not the spousal benefit or the survivor benefit, this is just you as the worker with some record you have out there. By delaying beyond age 62, you get an increase of 6% per year guaranteed in benefit. But Social Security also awards a cost of living every year. Cost of living, what they use is what's called a CPI, or Consumer Price Index. And the one that Social Security uses is called the CPIW. And the CPIW is the urban wage measure in big cities, what things cost and what people earn. And the average cost of living for Social Security, this is an older slide, 2018, last year was 5.9% for retirees. This average is a little over 2.5% in this example for a 25-year period of time. So you increase by not triggering your benefit, you get a guaranteed increase. Plus, on top of that, if there's an award of a cost of living, it increases it even more. Now, if I don't, if I wait till age 67 and I delay even further, I get rewarded even more. It'll go up by 8% per year, guaranteed, and along with the cost of living if awarded. And at age 70, that's when I stop getting these guaranteed increases, and the only thing I would get would be cost of living increases at that point. But the difference between age 70 and age 62, that 8 years, could mean a big difference in income. So there's not a right place or a wrong place to take it. It's the place that will work for you. And there's not like, I can't give you, you need to take it here. This is going to be very individualized for every single one of you. And what could affect that? Well, I don't need my Social Security right now, and my pension is doing just fine for me, and I'm not touching my deferred comp. So let's just let it grow. And maybe in a couple of years, if something changes in my lifestyle or I want to do something a little bit different, I'll trigger it and the income will come in and it'll be much higher. It could be that right now you're using your deferred compensation in order to supplement your lifestyle so that you can live, but there's the worry of running out of money in your deferred compensation, particularly in light of what we've seen happen with the markets. So maybe at 62 then, you just turn your Social Security on, and then you could decrease or even stop taking money out of your deferred compensation and let it continue to grow over the next number of years and then dip into it later. There's not a right or wrong. Everybody's going to be a little bit different. My dad was forced to retire at age 55 due to an injury and an illness. And he took his Social Security right at age 62 because he said, there's no way that I'd ever hit age 75. And I lost my dad last December. I lost him on Christmas morning at the age of 85. So he lost that bet. My in-laws, on the other hand, they ran a small business and it was going well, and the income was good and predictable, and they were very comfortable, and they had low debt load. At age 70, I had to sit them down at the computer and say, you guys have to take your Social Security. And their comment to me was, we don't want to take it because we'll have to pay taxes on it, and we don't want to pay the tax. So I made a deal with them. I said, then I'll pay the tax if you give me the income. And they realized that was a fool's bet, so they triggered their Social Security and they started taking it at age 70, and they've been rewarded greatly for that deferral. So the question will be always in this example is we have crossover points. So let's take that previous slide and let's take income at different points in time. And this is a hypothetical claiming at a certain age. And in this case, age 62. You can see here that the claim would be 2147 is what the math came out to at age 62. And at age 62, because I triggered my benefit, I no longer get those 6% guaranteed increases, and I don't get those 8% guaranteed increases anymore, but I do get a cost of living increase if it's awarded. So with that average being 2.6% in the example they use, by the time I hit 76, I would have pulled about $467,000 of income out of Social Security. And this stuff can all be calculated on and estimated on the Social Security website too. But if I didn't take it at 62 and I delayed, I not only got those increases that were guaranteed, but I got the cost of living increase. And again, they used 2.6. My claim would have gone up to $32.60 a month at the full retirement age. So by the time I hit 76, I would have pulled out $478,000. I would have crossed over. So by delaying that 5-year and getting those increases plus the cost of living, I would have pulled out a lot more money, but I would have had to start later. Now, if I get those 8% increases after my full retirement age, plus I get those cost of living increases, then I wouldn't trigger this till 70. By the time I hit 76, I would have pulled out $424,000 out of this system. But I would have had to delay for another 8 years. So, and if I have longevity on my side, you can see that I win the game big time by delaying. Everybody's different on this line, though. Not to say you should delay till 70 and then take it. So, but just an example of how these how these crossover points work, and these things can all be estimated on the Social Security site. So, we're still on the retired worker benefit, which is yours, and some of you may have a benefit of $300, $400, $500, $800 a month, for example. The first thing you want to do is you get an earnings record from Social Security and double check it. If you've already triggered Social Security, then I'm probably boring you to death right now, but if you haven't, check your record to make sure that you're credited properly with your income every single year. And it looks similar to what you see on here. This is just a copy of a record we pulled off from Social Security site. And then we're going to talk about Windfall Act. Let me see, before I go there, let me check another slide here. No, I don't have that one, okay. Windfall elimination. What is that? Well, let me expand the screen here for you. Oops. Windfall elimination provision affects how we calculate your retirement or disability benefit from Social Security. If you work for an employer who doesn't withhold Social Security taxes from your salary, such as a government agency, any retirement or disability pension work that you get from that work can reduce your Social Security benefits. So what do they do? How do they figure this out? Well, what they do is you have to go and look at your Social Security record that I was just showing you. And you're going to pull up that slide or that sheet from Social Security that shows your income back from wherever it may be. I first started working in 1978. My record began there. I grew up in LA. I was an LA Unified kid. I went to Marshall High School, and I parked cars at the Greek Theater. And I made $5,000 during that time period. Well, in 1978, what you see on the chart you have right here is called a substantial earnings chart. And so you've got to take your own personal record, which is the previous slide I showed you, and you got to compare it to this here. This is your substantial earnings. And in 1978, substantial earnings was $44.25. My Social Security record showed that I made $5,000. So that's 1 year of substantial earning. And then in 78, I made $6,000. Substantial was $44.25. or 79, 47, I have 2 years of substantial earnings. Now, why is that important? Because if you have 30 years of substantial earnings alongside of your record with the LA City, then you've earned through. You do not qualify for Windfall Act. You're going to get your full Social Security. My uncle, retired LA City firefighter, and he had a small business that he was running, and he paid into Social Security through all the years from his small business, and he had over 30 years of substantial earnings, so his record was not affected at all. What if you have, so you've got to check every one of these, and then what you're going to see is how many years that you have. And depending on how many years you have will determine how much of a reduction you'll see in the formula, not in your benefit, but in the formula that creates your benefit for Social Security. And if you have 20 or less years of substantial earnings, then you see a 40% here. If you have 30 or more years, then you see a 90% there. That's not your percentage of what you get. That's the first part of the Social Security formula that determines your benefit. So the formula will be reduced to 40% of the measure that they use, or it could be 90%, which is the normal one. That's the one you've earned through, or anywhere in between. Here's the bottom line without killing you with the math. The bottom line is here is that, let's say your record is $500, because the records I usually see for LA City employees are pretty small. It's not usually a full $1,200, $1,500, or $1,800. When you apply for your Social Security, you'll never see more than half of it disappear. Maximum is just under $500. So if your record shows $1,200, you're not going to lose $600. You'll lose probably about $480, right around there. If your record is $300, you'll probably lose right about half of it. So you have more like $150. That's what we usually see. So I'm not going to bore you with the formula and how they do it, but the formula is actually right on the sheet over here. And what they do, just to tell you very briefly what they do, is they go out. I know I'm going to lose you here, but I just got to do this. Apologize. But I'm going to use me as the example. They're going to take my record for all the years that I've worked. When I was parking cars at the Greek Theater, I was making $5,000 a year there, but that's not $5,000 now. They're going to inflate that number up to what it is worth today. They have their own inflation factor that they use. And then they're going to take all the highest 35 years of my income. And if I only have 30 years, then I'm going to have 5 years of zeros. If I only have 20 years, then I have 10 years of zeros. And they're going to average those out once they inflate the numbers up. And they're going to divide by 12, which gives an average indexed monthly earnings. They call it the AIME. And that's kind of like my average earnings in my Social Security record over my time. And then they're going to apply the Social Security formula for my pension against that $3,000, $4,000, $5,000 a month. And what that formula is, it says right here, for the first $926 of that $3,000, I get 90%. That's that 90% that's over here, right up over here. But if I have 20 or less years of substantial earnings, then that 90 only becomes 40. And that's what kills your Social Security benefit with the Windfall Act. So bottom line on this one, if your benefit is under $800, you're probably going to see about half of it go away. If your benefit is greater than that, you'll never see more than about 480. You could use the number 500, 450, right in there, right in that area. You'll never see more than that go away. So I'm going to check right now to see if I have any questions on that. I do. All right. I said, what is the impact if a spouse retired from LAUSD having a pension and will be receiving Social Security this year? Will it be adjusted as I've just retired? Yes. If it depends, LAUSD, if I think back properly, I think some people did have a time when they paid into Social Security and some didn't. If the rule is if they receive a pension from LAUSD, which would be the State Teachers Retirement System, and they did not pay into Social Security, then they would be subject to this Windfall Act that I just went through. And I would urge you to get to the Social Security Administrative Office, and they'll help you. You can go online and do it too. You can estimate how it would affect you, but they can tell you in person exactly how that would work. If you didn't apply for a spousal early, is there a time limit? Generally, what happens with the spousal is that when you do apply, they should double check you that there is a difference between the two. That's usually the standard procedure. If that's not the case, I got to send you back to your Social Security office and figure out why that didn't happen and how that spousal benefit might have been calculated. Because typically it is done automatically, is what I'm told by them. Rob, does your Social Security still send out statements of at various ages? You know, I'm hearing that over certain ages they are sending them out again. However, I haven't received one in the last probably 3 or 4 years, and I'm 58 years old. So it might be different. I just don't know. I haven't seen it for a number of years, but I was told that over certain ages they were sending them out. But personally, I haven't been receiving them. But I do log on to ssa.gov, and I've created my own login, and I do check it myself. So maybe because I have a login, they're not sending it to me. Does Windfall Act apply to city and non-public employees? Windfall Act will apply to you if you have a pension from a government entity that you did not pay into Social Security. So that would be a city plan. It could be, in many cases, the federal plans too. We see them with teachers that are under the state teachers retirement system. So really the rule is not so much who your employer is are you receiving a pension, and when you were paid by that place, did you not pay into Social Security? Like there is in the state of California, this public employee retirement system, and there's a lot of people that are employed under PERS that do pay into Social Security, so they'll get their PERS and Social Security. So it just depends on the source, going back to if you worked for a government entity that did not pay into Social Security. My SSA earning records does not show my city earnings. Is this an error? No, what your SSA record shows is your Social Security earnings. So if you didn't pay on those, you notice there'll be 2 columns on the, I'll go back on a couple of slides. There'll be 2 columns in your Social Security record. There'll be your Social Security earnings, and there'll be your Medicare earnings. You did pay on Medicare. So your city earnings should show under that Medicare column, but not under the Social Security earnings because you didn't pay on them. That's what you usually will see. Let's see, that seems to be my last question there. I'm just going to go back to that slide just to show you real quick. And this is it here. So I'll show your taxed Social Security earnings and your taxed Medicare earnings. When you do not pay into the Social Security system, these will be zeros over here, and these will have your Medicare wages because you do pay into Medicare Part A. This is your Part A. You're paying 1.45 right now, and the city's paying another 1.45 for your Medicare earnings until you retire. So now, question comes up all the time, working while collecting Social Security. What if I'm earning? Well, you can go back to work. In fact, a lot of people do go back to work because they go do stuff that they like doing. Maybe they turn their hobby into a business and they're earning money. Maybe you need the extra money and the work is easy. Maybe you went back to the city and you're consulting. Many, many people seek out retirement or earnings after retirement employment. But we have to be very careful. What if I earn wages and I trigger my Social Security, which is the earliest is 62? Well, you can get Social Security retirement benefits and work at the same time. However, if you're younger than the full retirement age and you make more than the yearly earnings limit, your Social Security benefit can be reduced, starting with the month you reach full retirement age. Okay, we will not reduce your benefits no matter how much you earn. What that means until you reach your full retirement age. Now, how does that work? Well, the number for 2022 is $19,560. That's earned wages. Don't confuse it with your LACERS pension or money that you've taken out of your deferred compensation, or that you sold your home and you had a gain of $65,000, or you had some stock and you cashed in and you had a capital gain on that. That's not wages. These are earned wages where you earned money and then you paid Social Security taxes on them. If you earned more than $19,560, then what it says is that for every $2 you earn above that, you will get $1 deducted from your Social Security benefit. Oops, hit the wrong button there. There we go. Now, starting with the month you reach full retirement age, you can get your benefits with no limits on your earnings. So if you are earning and you want to trigger your Social Security, be careful because your Social Security could be reduced as a result of your employment prior to age 67. And every year that limit goes up. For 2022, it's just under $20,000. Last year is $18,860. So it goes up a little bit every single year. And here is the publication for Social Security that has that, how the limits work on that. So that's the publication if you just want to go find it, and that'll be right off the Social Security site. So the next question that always comes up is, well, is my Social Security going to be taxed? Well, that actually got snuck in a few years ago. Some of you are going to have to pay federal income taxes, and in California, maybe in California you won't, but in other states you may pay state taxes on your Social Security income. This usually happens only if you have other income in addition to these benefits, such as wages, self-employment, dividends, things like that. So what you're going to find is that, let's just go down to this third bullet point. If you file as an individual and your income, combined income is between, it says combined income, but that's straight off their site, is between $25,000 and $34,000. So you'd have to pay income tax on half of your Social Security benefits. So if you receive $20,000, they're going to charge you tax on $10,000. They're going to include into your income. Now, if you make less than $25,000, then your Social Security will not be taxed at all. If you make more than $34,000 and up, 85% of your Social Security benefits will be added into your income. So 85% of $20,000 would be $17,000. $17,000 would be added into your income. And for most people on here, your pension alone from LACERS will probably exceed $34,000. So you could probably count on most of your 85% of your Social Security income being taxed. If you file a joint return, then the number goes up a little bit higher. If it's between $32,000 and $44,000, you'd pay tax on half of that income. And if it's more than $44,000, then 85% of your Social Security income would be taxable. And that is a nice little piece here that you can just copy and stick in the browser, and it'll take you right to the Social Security site, which would explain that in a lot more depth, but not always in such plain English. Caution items. This I'm not as familiar with because I don't handle many benefits for people that are in the LACER system. Well, I don't in the LAFPP system either, but you have very unique benefits, health benefits. And these are just caution items that if you have questions around these, I'm going to direct back to the LACER staff. But when you hit 65, you're not at your full retirement age. Your full retirement age will probably be around 67. But when you hit age 65, Medicare is part of the Social Security Act. And if you fail to enroll in your Medicare or do not pay the premium at age 65, you could put your LACERS plan, your retiree health plan, in jeopardy. So at age 65, your Medicare enrollment is required by your LACERS plan. Your Part A of Medicare is free because we paid for it while you were working. And your Part B is required. It's required that you have it. And the premium is just over $170. I think it's $170.10 a month right now. And your Medicare Part B premiums are required to be paid, and they can be billed from Medicare. They can be auto-deducted from your checking account, or they can be deducted from your Social Security check if you've triggered it already. Just the caution items that I want to bring up is you'll no longer be eligible for a LACERS medical subsidy if you fail to pay the Medicare premiums. Your LACERS senior medical plan coverage and that of your dependents will be terminated. The Centers for Medicare and Medicaid Service will be alerted your medical plan and will notify LACERS of your lapse. So LACERS will know if you didn't pay. And if you do enroll late into Medicare, the Part B, they have enrollment penalties that are late, 10% per year, and it's permanent. So what I'm going to caution you to do is just remember 65 is a very, very important age for your medical benefits going into retirement. And I'm going to urge you to have any questions, go back to your LACER staff that know this stuff very well, and they'll be able to guide you on exactly what you can and should do and not put your medical coverage in jeopardy at retirement. This is just a slide. Social Security has many, many other benefits. What I gave you was just a quick summary. Many people think that Social Security is just a retirement program, and most of the people receiving benefits are retired, but others receive benefits because they're disabled, their spouse, they've been widowed or widowered. There's no word as widowed. That's off. What movie is that? One of the Tom Hanks, Meg Ryan movies. A spouse or a child, someone getting benefits, a divorced spouse, a spouse or a child of a worker who died, a divorced spouse of a worker who died, a dependent parent of a worker who died. But kind of interesting fact that they give around is, depending on your circumstances, you may be eligible for Social Security at any age. In fact, Social Security pays more benefits to children than any other government program. That's direct from the service there. But one of the benefits that I had on previous slides was around an older parent or a guardian benefit. And if any of you are you're over the age of 62 and you're caring for a child, it could be an adopted child, it could be that you are a guardian of that child, then it could be a grandchild, doesn't have to be a blood relative. But if you were the guardian of that child, there may be a benefit for you from Social Security in addition to your own personal benefit for caring for that child. So I'd urge you to look at Social Security or contact them and to find out more about that if that's the case. There's a number of people we're bumping into that's happening more and more. So in summary, ssa.gov is where you need to go. You can check your record there. You have to create a login if you haven't already done so. You can have your Windfall Act calculated there. You can set an appointment at your local office and talk to the people there. We discussed government pension offset, which is survivor benefits and spousal benefits. Think about this Social Security benefit in your own plans. Don't think of it separately in your own plans, like, oh, I'll get it at 62. But think about how it might integrate then with your overall income package of your Lacer's pension, your deferred compensation, your other savings, maybe some employment. And again, delaying it might provide an advantage for you if you do have employment or you are not withdrawing from your deferred compensation. By delaying, it will increase it. So there's strategies around that can help you in building this entire paycheck while you're in retirement. There's not a lot of easy answers usually with this stuff. So again, I'm going to urge you to go to your Social Security Administrative Office, talk to the folks, and they should be able to help you. Okay, just some quick questions that we have here. Am I paying into Social Security? How many quarters have I earned? We talked about how much more you would have to earn in order to get credits for Social Security to get to the full amount. How much would it be? When would you plan on taking it? Did my spouse get Social Security benefits? If my spouse predeceases me, what is my survivor benefit? Would I have one? And look at your statement and Social Security to see if the earnings that you've made are credited properly. There's records there's Social Security numbers that are hijacked, and people are using those numbers and they're getting employed and they're going to your record, which pads your record. But also, a lot of times the money may not make it to Social Security or credited properly, and you didn't get it credited. So you need that in order to keep that benefit and to restore that benefit to the full amount. So double check those. I haven't seen many of those errors, but I have heard that they exist out there. Now I'm going to check for the questions again real quick. I got a few more here. I will not get Social Security, but I'm receiving my parents' retirement. Will that windfall affect me? The question is not going to be on what you're receiving as a beneficiary. I think more so it'll be, what are you receiving as a retiree from the city? So I don't think that a beneficiary pension is what would affect you. I think it's the one that you earned. But I'm kind of going out on a limb on that one. I would definitely, Tanya, I would tell you to head to the Social Security Administrative Office and show them what you got with Lacer's, and then explain to them what you're receiving as a beneficiary of a pension, and double check your Social Security there. I'm sorry, I don't know, but I'm guessing, almost positive, that is not going to affect your, the one that you're receiving as a beneficiary is not one that you earned while you were working. It'll be your Lacer's that'll come into play. But I want them to tell you that. If you reach full retirement age and happen to make more than the Social benefit, you will not receive reduced benefits because you waited until you're full. Let's see, Catherine, I'm trying to read through this. If you reach full and happen to make more, yes. And the Social Security benefit we're talking about is the $19,560. You could make $1 million after your full retirement age, and it will not reduce your Social Security at all. You will not be affected by that at all. I think that's what you're asking. Is this particular section about Medicare only apply to city employees? Yes, that one particular piece is because you have a unique healthcare plan that you take into retirement, and I'm not part of that, so it doesn't affect me. But that quick piece that I went through on caution items does affect you. That doesn't apply to everybody else. That was just unique to a retired person under Lacers that was taking the healthcare into retirement there. I think I'm correct on that, Stephanie. Okay. Let's keep going here. Let's go to the last piece here, and then we will cut for the day, and it's deferred compensation. Now, deferred compensation, and I'm going to say here, other eligible savings plans. This is the part 3 of your retirement paycheck three-legged stool. Your Lacers pension being 1, Social Security being 2, and your deferred comp being 3. I've got some basics around it. I'm not going to spend a lot of time on the basics because a lot of you are already retired. It would just be kind of like a quick reminder, or just in case there's somebody here that's on the line that is still current. But again, your deferred compensation plan through Voya, it helps you accumulate money, and it helps you deaccumulate or distribute. And so you need to have strategies for both. Again, we got to think of it as a continual journey. And the statement that I will use is, what do we need the money for? And if we can figure out what we need the money for and zero in or get closer on that, or be able to close in the navigational buoys on that one, what do I need the money for and how much? That answers a lot of our questions. That answers a lot of the questions that I'll hit in the next couple slides. So we need to begin with the end in mind. What do I need the money for? If we don't know what we need it for, then it's kind of hard to make decisions. So we do have 2 different types of deferred comps. We've got the traditional one, which is on the left, where we put the money in pre-tax. We got a tax break for that. And when it grows tax deferred, which means that we don't pay any taxes on the growth. So when it went into the various investment funds and you did really well, you don't pay tax on that, but it is taxable when you take it out. Okay. Now, how taxes apply and how penalties apply, I'm going to have to send you back to your tax advisor for that. But we're going to talk about penalties. 2 things apply to your money coming out from your deferred comp: taxes and penalties. Penalties will be early withdrawal penalties. So we're going to hit those in a little bit. There was added in to your Voya deferred comp a number of years back, the Roth. And the Roth is not an acronym for like retirement of the healthy. Roth was an act introduced by, I think it was a senator or a congressperson, Roth, that changed the tax timing on how you put money into your deferred comp. So we have traditional deferred comp over here, and we have Roth deferred comp over on the right-hand panel. On the Roth side, you put money in after tax. The money grows tax-free if you stick to the rules, and when you take it out, it's tax-free. And the rules are that you have to be 59 and a half, and the account had to have been opened for 5 years. So it's 5 years plus age 59 and a half. So all it did was change the tax timing. Well, people always ask me which one is better. You're already in retirement for most of you on this call, if not all of you. You've saved where it is. You won't be able to contribute to it anymore. But what I can tell you that the danger here is that we're going to worry about penalties, and we're going to worry about if you save money in the Roth side before you're retired, that you just make sure that you open it up 5 years prior, and that just is your first contribution, and that you've reached 59 and a half. And if you do so, you're going to get great, great benefits from the Roth, which means you can take the money out without paying any taxes. Okay. Now, while we're working and we're putting money away under our deferred comp, seems like we have lots of time. So we're coming up the mountain. We haven't planted our retirement flag. We always seem to be, well, it went down a little bit, but we got time, and There's always more where that's going to come from. You have an inability to see volatility because you could put as much as $27,000 a year between the basic contribution and the catch-up into your deferred compensation, either the Roth or the traditional. So it kind of buffers your loss. You don't see it quite as much. And it gives you a feeling of abundance, which is a really, really good feeling. The minute you retire, suddenly you realize, I can't contribute to this anymore. This is all I have. This market volatility is now apparent. So you're going to see the market change and adjust, and you're going to see your accounts hit a little bit harder because you don't have the money going into it anymore. And it gives you a feeling of scarcity, which is really not a bad thing, because scarcity will prevent you from just dipping into it, and running out. So what are the common concerns we hear from city employees upon retirement? Well, first, what are my options with my deferred comp? Can I transfer it out, all of it or part of it, or can I just leave it there? Well, the answer is yes, you can transfer your deferred comp savings out to another financial institution. And if you did so, it would probably be in what is called an IRA. And an IRA does not mean more risk. It is nothing more than another retirement account that could receive your deferred comp money and allow it to be moved and not be taxed. So you could move all of it to, or part of it to, an IRA. And what I really wanted to let you know here is you do not have to make all or none decisions with your deferred compensation money. You could make 5 different decisions with your deferred comp, but we tend to think of things as being all or none. So you could transfer all or part of it out to a financial institution. Let's say I saved $250,000 into my deferred comp, and I have somebody that has a different investment option for me, or something that there's many, many vehicles out there that can do different things for me that may not be available in my deferred comp. Well, they can help you, and they can manage that money into whatever that unique product or investment might be in an IRA. Or you can just leave it all there. And I occasionally hear from city people, get your money out because it's with the city and you could lose it if the city goes bankrupt. And you can thank Orange County and their bankruptcy for this, because your money is now no longer subject to the city creditors. It is held in trust. So it's not subject to the creditors of the city of Los Angeles, nor is it subject to your creditors if they come after you. So it's creditor protected. Can I take income from my deferred compensation account? Of course you can. But I think some of the concerns that come after that is, well, if you do, what if you hit it too hard? How long is that going to last? And as a result, how should I be invested? How is it going to be taxed? And what are the penalties that apply? We're going to hit those bullet points here in the next few slides. The last thing on this particular slide that I want to talk about, though, is transferring your money to another financial institution to work with another advisor or to self-direct your investments. Okay, that would typically be, if you self-directed or you did work with another advisor, it would be in an IRA. And I'm just going to say that if you are considering this, we call them the C's here. Number one, will I have better control over the flow or accessing my money? Will I have better choices that I can invest, broader choices in this IRA than what I can do in my deferred compensation? If I have leftovers and I haven't used it all up and leaving it to my spouse or children, is it easier to do in my deferred compensation or in an IRA? If I take my money and I transfer it to an IRA, I may have penalties. I'm going to go over penalties in a minute that are different from the deferred comp. So you may, by moving your money over, subject yourself to new penalties that you weren't aware of when you access your money. You got to consider fees. There may be more fees in the investing of your money in the IRA that you're working with, either self-directed or with the advisor. But fees are not bad in the absence of value. And value could be advice. Value could be in harvesting money from your retirement accounts. Value could be in helping you through this difficult time that we're in right now and helping you stay the course. Value could be in helping you estimate and create consistent retirement income for you. And value can be in finding unique products that can provide guaranteed income for you that are out there. So there is value out there. Fees in the absence of value are nothing more than an expense. And then last, one of the very, very wonderful things you guys have with your deferred compensation is you have retiree loans. And those are not available if you transfer your money out to another financial institution. IRAs do not have those retiree loans. So there's some real good things with your deferred comp, but I'm also not saying don't consider working with a financial advisor or self-directing. Just be careful of some of the things. In particular, loans are gone, fees could be higher, but choices in harvesting and other things could be to work to your advantage as a result. And again, it's not all or none. You could do a little bit of it. You saved $250,000 in your deferred comp, and then now you could move $50,000 over there and leave 200 back in deferred comp and do different things with it. So I got a few questions here. I haven't triggered the use of deferred comp 72, but I believe RMDs start at that time. Is there a chart that shows how much money to distribute? Charlene, I don't have that on the slide, but the answer is yes. You can look it up. You could put up required minimum. I'll hit that in a minute. Required minimum distribution and retirement plans. Voya also can provide you with a chart of distribution. The problem is that it's a function of a balance of your previous year. So, for instance, people have to take right now required minimum distributions from their deferred comp based on their 12/31/2021 balance. So you have to take out a certain amount. The amount at that age is getting real close to 3.5% of whatever my balance was on December 31st of 2021. So I take the amount out. But I've also had a pretty rough year in the investments this year. And so my balance on 12/31 of 2022 may be a lot lower than it was on 12/31/2021. I may have to take a higher amount, 3.6%, but it'll be a less amount because it's on a smaller balance. So every year, how much you're supposed to take out is based on your previous year's balance. So Voya will give you that. They have that available. And if you have your money somewhere else with a financial advisor, the IRAs will also have their required minimum distribution numbers for you too. They'll be able to provide them to you. The question came out, please explain the benefits of an IRA. An IRA is just nothing more than a vehicle that'll prevent you from being taxed. It's what you do inside the IRA that could be your advantage. For instance, let's say that, I think I have a chart coming up. I'll show you that in the next couple of slides. So I'll answer that question there. There we go. What are my goals in retirement? I hijacked this slide from JP Morgan. This is one of my favorite slides because it helps me kind of go back to what do I need the money for? And what JP Morgan is showing here, and you probably can't see it on your screen, I'll expand it, is do I need the money, do I want the money, or do I want to leave the money to somebody? And again, it can't be all or none. It could be all three. So, expanding this, if I need the money, the base of this income pyramid, and I need steady, predictable, reliable income in retirement, well, the vehicles that I would get that from, Social Security and pension, those are two guaranteed items. And that's a big part of that retirement paycheck for you. Then beyond that would be annuities. Annuities are issued by insurance companies, and they're guaranteed income for periods of time. It could also be for life. So you could transfer out part of your deferred compensation to an annuity company, an insurance company. Insurance companies are the only companies that can issue annuities. Banks can't, wirehouses can't. If they do, it's because they're using an insurance company behind it. But only insurance companies can manage longevity in an annuity. An annuity would pay you an income for a time period or for life. So I could transfer out, if I had $250,000 in my deferred compensation, I transferred out $100 to an annuity, I could get another, let's say, guaranteed $800 a month for the rest of my life. Well, that would be in an IRA. So that would be an advantage that would make sense to you. I need that income. I don't want to manage my assets for it. I need to make sure that that check is in my mailbox on the first of every month so I can live. An annuity is a very good instrument for that stable, steady income. High quality bonds that you could purchase. You can't purchase bonds separately inside of your deferred comp. You can purchase it though inside of an IRA, and bonds would create income for you. And you hold the bonds till their maturity, and then you would have income from them. And then cash and cash alternatives. So when I need money, we need it in predictable, stable places that can create that income. Now I want the income, but I don't need it. I'd like to get a little bit more So maybe we can have a little different strategy. My pension, a little bit of work, my Social Security is giving me the income that I need. And now I got my money in my deferred comp. And when I am in the wants category, I can probably stretch out and have my monies invested maybe a little more aggressively. I can go into stocks and bonds and different asset classes, balanced, aggressive, things like that. I can have asset allocation. And I've got my $250,000 sitting there, and I have a good year. My 250 goes to 300. Well, a strategy that's very common would be, I'm just going to harvest the gain. So I'll take $50,000 out, I'll pay the taxes, my balance goes back to $250,000, and then the next year it goes down to $230,000. Bad year. I don't touch the money, no bonus, no retirement income bonus. I wait another year, and then it goes back up to 270. I take another $20,000 out. We kind of call that the 11th commandment spending, which is thou shalt not spend principal. You only harvest the gain. So that's an example of many types of ways to harvest income for wants. Wants could be that I just leave it and I just keep it invested, and somewhere down the road, then I turn it into needs. And when I turn it into needs, then maybe I change the allocations from being more aggressive to much less aggressive to more predictable items. And then there's legacy. I don't need the money, I saved it, and I'll harvest some and have some fun, or maybe just part of it I'm going to peel off, and I'm going to do it myself, and I'm going to buy Bitcoin in my IRA, and I'm going to do alternative investments and maybe buy all kinds of fun things in there, and it's going to do great. I could turn 50,000 into 500, and I could turn it into zero. But whatever's there, that's what the kids are going to get. Everything else is for me and my spouse and my partner. So I like this slide because I like the hierarchy of needs, wants, and legacy, and how we invest will be a function of what the money is there for. Now, your deferred comp and other retirement accounts, which could be an IRA, income planning, begin with the end in mind. What is needed? How much is needed? I can defer until later and stay invested if it's not needed. I can tell the Voya or the IRA company or the financial advisor to withdraw only investment gain or interest gain. I could tell them to set me up on a schedule, send me $1,000 a month, like what I showed you in those paycheck comparisons. One person needed $1,250 a month, one needed $750 a month, one needed $250 a month. And you could then look back at that and say, well, if I take that amount out, how long will it last, and how should I be invested in either working with this yourself or with a financial advisor? Or you can take it to an insurance company and give part of your money to an annuity and have that annuity create that income for you that would be guaranteed and wouldn't be difficult to manage. Or it could be a combination of all the above. But one very, 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 very minor mistake I see a lot. I get this phone call into my office probably about 10 times a year. And it sounds like this. My spouse passed away and they forgot to change the beneficiary on their deferred comp, or they're in the municipal, the system with the teachers, the 403B, or they're in the federal system, it's their thrift savings plan. I forgot to change the benefit, or they forgot to change it. Can you help me get my money? The answer is no. So one thing I'm going to ask all of you to do, if one note to take down, is to check your beneficiaries, one, of any life insurance that you have that you've taken into retirement, two, for any of your investment accounts or retirement accounts, your deferred comp, et cetera. Check those beneficiaries. It could be a former spouse. It could be a child. You may not want the child to have that money. There could be spendthrift problems. Check your beneficiaries on these accounts, because that money will go to whoever you list there. So we'll talk about income taxes on this next session, but you will be taxed when you take money out of the traditional side. There's no way around that. There's no way, if you move to Costa Rica, you're still going to pay federal income taxes. If you stay in California, you're still going to pay state and federal income taxes on that money. No way around it unless it's Roth. Now, we also, though, have, on top of income taxes, we have penalties for accessing this money at odd times or not accessing this money properly. So taxes will be due, but penalties can be avoided. Because you're in a deferred compensation plan, this is unique to you in the city. This is not going to affect you if you're married to an educator or you're a federal employee or someone that's in a 401k. This is just unique to you being in a deferred compensation plan with the city of LA. And the 457 plan is the IRS code for that. That's why it says 457 in this. So anytime you take money from your deferred compensation, if you're retired and separated from service, there are no early withdrawal penalties. However, if I transfer my money to an IRA is not deferred compensation. I didn't pay tax when I moved the money over. However, when I access the money, if I'm not 59 and a half, I may pay a 10% penalty tax for accessing that money early. Okay? And my Roth money in my deferred comp has to have 5 years plus age 59 and a half to get all the tax-free goodies. So this 59 and a half rule will apply to deferred compensation. So I see oftentimes that people save money in deferred comp and they work with a financial advisor and they moved it over to an IRA and now they're 57 years old and they need income. And the advisor's going, well, you know, if we take the income, you're going to get taxed, you know, but there's penalties too. Now there's ways to get around the penalties, but they're not that easy to do. They're called 72T withdrawals. I don't have this in the presentation. It would really put you to sleep, but just understand that if you are going to move money to an IRA and work with a financial advisor or do it yourself, make sure you understand the early withdrawal penalties from that. Now, these accounts all have late withdrawal penalties too. That's called required minimum distributions. And I have here 70 and a half was the old rule, and the Secure Act now has moved that up to age 72. And that was one of the questions that came in. Must be required, begin required minimum distributions. And what the IRS says is that you made a deal with them that you were going to take money out of your paycheck, you weren't going to pay tax on it, you were going to invest it and let it grow, you weren't going to pay tax on it, and you were going to take it out at retirement at some point. Well, we don't want to wait too long. We want you to start touching that money. So required minimum distribution is them forcing their hand for you to start taking money out of these accounts. And that was the question, how much do I take out, is a function of the end of year balance prior to the year. So it does vary every single year. And the amount that you take out does increase a little bit each year too, throughout your retirement years. So Voya can give you how much you would need to take out. And if you have your money in an IRA, it's a little different measurement. They'd be able to tell you that too. If you don't take out money when you're supposed to, you'll be penalized 50% for what you didn't take out. Plus you'll be taxed on the entire amount. So you'll lose about 3/4 of it to taxes if you don't pay attention to that required minimum distribution. Okay. I'm going to skip this slide for a second and go back to see if there's any questions. Let's see. Okay, good. Okay, Catherine, I got your answer. Cool. I haven't triggered the use of deferred, but I believe RMD started at that time. Yes, I didn't have that chart. So Charlene, that was the chart I don't have, but they can get you that with Voya. Please explain benefits of IRA. I got that one. Do you have a contact number for Voya? I don't have that. It'll be on your statement though. You can call that, or you can call the reps probably downtown, that sit there. I think there's 3 or 4 of them that sit in there. They're all pretty well tenured and know the product really well. They can help you there too. Look on your statement for contacting Voya directly, or just contacting them down there at their seat at downtown. This is the last thing that I have. Next couple of slides. This is a chart of the S&P 500. The S&P 500 is a very common fund that people get into. It's low expense, and it's basically Standard & Poor's 500 companies that feel represent our economy. And this chart shows, the red dots show how far down that account went in that particular year. And then the bar graph will show where it closed at the end of the year. And all I want to show you on this graph, not getting deep into this, is that if you don't need the money, your best ally is back to the want or the legacy. If you don't need the money, if you want it or it's for legacy, your best investment strategy is to get in and to stay in. Right now, you've seen your accounts adjust a little bit, and there's a little bit of scare that's going on. And if you don't have any plan for the money, I understand that. That's why. You don't know what you need the money for. There's worry that you see it erode. You may not be touching it, but you don't want it to go away. But if you don't need it, give it a chance to grow. And this is what this chart really shows, is that, for instance, in 1980, the S&P 500 was down as much as 17%, but at the end of the year, it closed out plus 26%. That's a pretty wide span on how much it varied during the course of that year. 1987 was my first crash that I dealt with in the career, and I was too naive to really know what was happening. That market went down as much as 34% in the S&P 500 that year, and that was in October. And then look what happened by year end. It was up 2%. Look at this, the increase, 36% in a 2-month period of time. But people got scared and they jumped out and they missed all of this time going back. And so they missed the whole run up. We could do no wrong in the 90s. The market was just going great guns. Every year was double-digit plus returns. And this is the S&P 500. But if you were invested in tech, it was even double this or more. But then we hit the 2000s, and look at it. We have 3 years in a row where we have a down market. And people got scared here, and they didn't get to enjoy the next few years. And then look what happened in 2008. We had the market down almost half at the worst point. The S&P 500 had closed out at minus 38. But then look at the next few years. What we see in this example is the wide span, the variation. But what we also see is that the market was down about 20% of the time. That means that 80% of the time it was up. And if you have the intestinal fortitude and you don't need the money, your best defense is to ride it out. Stay in the market, stay invested, and it will do what it has normally done, which is it'll correct, and we'll see it get back on a path that will create positive returns. A couple quick things. I want to talk about how our accounts grow, because it's very difficult to predict how our accounts grow. This is just kind of my wind down for this section here. And why I do this is because a lot of our calculations to try to figure out how much money might be there in the future get kind of goofed up because we apply a rate of return to it. It looks like this. And I'm going to say, would you rather have 5% average return on your money or 10%? And you're going to say, hey, Rob, you know, I know they made marijuana legal in Los Angeles and California, and I hope you're not using it because that's a stupid question. Of course, I'd rather have 10%. Well, what I want to show you that average returns are math. Your account balance is money, and there's a difference between math and money. So I'm going to show you an average return of 5%. I have $100, and it earns 5%, it's 105. And it earns another 5%, and it's 110 and change. I've rounded up. And then it earns another 5%, it's 115 and change. I earn another 5%, it's 121 and change. And then I earn another 5%, it's 127. At the end of 5 years, I have $127. What is my average return? It's 5 plus 5 plus 5 plus 5 plus 5, which is 25, divided by 5 years. My average return is 5%. That's pretty simple. Well, let's go over and show an average of 10% now, but I'm going to show you how sequencing of returns, or math and money, are two completely different things. $100, I double my money in the first year, it's $200. I lose 80% of it in the second year, it's $40. I earn 40% in the third year, it's up to $56. Fourth year, I lose 20%, it's $44. And in the fifth year, I earn 10%, it's $49. What's my average return? Well, all I do for an average return is I add these all together and divide by 5. So 100 minus 80 is 20, plus 40 is 60, minus 20 is 40, plus 10 is 50. So 50 divided by 5 years, my average return is 10%, but I only got $49 in my account. How in the world can I average 10% and lose half my money? That's the difference between math and money. Math is nothing more than averaging these out. Money is your account. And how these returns and when they hit your account are key. Why I lost half my money is because I had the largest loss on my highest balance. When that happens, it's really hard to earn that money back. It takes a while. So let's make this in a real life example. The problem is that if you look at your deferred compensation performances, where do you go to say how much money will be there in the future? What do you use? What in the world do you use? What portfolio are you in? Do you use the average returns that they have here? And that's the problem, is these are average returns. Oops, Come on. Yep. There we go. So what do I use? These average returns. Look at I got a 5-year average return on this portfolio for my moderate portfolio of 10.8. And so when we ask people, what should we use? They go and look and they say, use 10% going forward. And that's going to lead you to disaster, because average return is just taking those numbers and adding them and dividing by the number of years. So let's make it a real live example here. If I were to put, this is an example I use all the time, $10,000 a year, or I'm sorry, $6,700 away, $260 a year away into my deferred comp, and I'm a new employee, and I say, well, how much might be there in 25 years? Okay, I put away $67.60 a year. I looked at my average return for the account that I'm in for the long period of time. It's 12.24%. I'll tell you why I use this number. And this is what the math on these calculators do. This is what it's showing you it's earning every year. It's like that 5% return. That would be true if it were a CD that was locked in for 25 years at 12.24. And then I'd have $1 million in my account. I wanted to get to the magical $1 million number. But what if I was actually in the S&P 500 fund, and I was in that fund, and that fund averaged 12.24%. It averaged it from 1985 until 2010. 2010. It averaged 12.24%. And this is how it did it: 31 and 18 and 5 and 16 and 31 and -3. If we add these all up and divide by 25, we get 12.24%. But look at my balance. It's only 568,000. It's half of what I just showed you here. But they were both 12.24% averages, but they got about to those averages differently. And what killed this one here was I had my highest loss, -37, on my greatest balance of $700,695. I lost $250,000 that year. Dollars is your balance. Average is the math. We can't confuse the two. So if you want to predict how much money might be there in the future, go to those average charts and take what the long-term investment record is and at least cut it in half or more. I will use 3 to 4% just to be so on the low side, so that we can see if it can survive in a difficult environment as opposed to a really good environment. If it can survive in a difficult environment and create the income that you need, then the solution works. Now, one last thing that the LAFPP always asks me to add in is, because if you do have people managing your money for you, if you're to take your money out of the deferred comp and move it over to an advisor, they're going to charge a fee in a lot of instances to invest that money for you above what you pay in your deferred compensation. And again, a fee in absence of value is nothing more than an expense. But a 1% fee doesn't sound like a whole lot. But if we look at it, these red numbers represent what that fee was for that year. And if we look at my balance, it's 476 here after that small fee versus 568 without that extra fee there. So it is an eroding factor if there's no value in it. But where would a financial advisor help you? They'll help you if you need the money versus want the money. They're going to help you in creation of income and harvesting the income at the appropriate time, what accounts to pull it from, how much. They're going to help you understand how long it would last if you hit it too hard. Or you can do that yourself just by educating yourself a little bit on it. But you need to have those pieces, and it starts with, what do I need the money for? So will this be taxable for you in retirement? For most of you, it will be. Do I need to supplement my LACERS pension right away, or can I wait? Can I wait to defer to what age? Do I need to put away additional money? What am I using as an interest rate to generate that going forward? Will that help me get to my 100% of my take-home pay? How much would I be taking out in order to do that? And what percentage would I need in order to survive and to keep that account balance alive for the rest of my life? Or do I run out of money? Some questions that we can ask there. So, who's the beneficiary on your deferred compensation? Do you have other sources of retirement planning income that you could take, or maybe employment, rather than using your deferred comp right now? Other than income, are you planning on, I hear this a lot, I'm going to pull my money out of my deferred comp and pay off my mortgage. I understand being free and clear of a mortgage. I get it. It helps you with the secure feeling, but you're going to erode an awful lot of your money immediately in the form of taxation, which we'll hit in the next section. And maybe there's a better alternative, that maybe you just take the money out of your deferred comp monthly to pay your mortgage. You'll pay the tax on it, but then it leaves all the other money behind to continue to earn and grow, so that maybe that money will still be there when your mortgage is paid off. And it would be a little bit of a security blanket for you still to be able to dip into if needed. So again, you'll have this presentation, important links. A lot of the stuff that I talked about today, ssa.gov, retirementliving.com, taxes by state is that's a great link I can take that you can go to. And what they'll do is show you what taxes are in various states. If you move there, from gasoline tax to cigarette tax to state income tax. The retirement plans is Vanguard piece here is a public site with Vanguard where you're able to go in and you can you can put in how much is in your deferred comp. You can put a very broad allocation on how you're invested. You can put in how much you want to pull out, and then it'll go back and back test it and say, what's the probability of you running out of money based on 100,000 different conditions in the market? And then we've got, of course, all the great Lacers pieces, your YouTube pieces for your health, for your pension, which will help you through understanding some of the benefits a little bit more. So that'll be on the presentation. You can take those and put them right in your browser. And with that, I'm going to open it to questions and see if we have any more that's come through on the chat box.
Basically, I know that my deferred comp portfolio is an aggressive portfolio, but I saw that there's moderate investing, there's ultra aggressive investing, and then conservative. I just wanted to know which would be the better route to go. I thought when I initially started, I went the aggressive route because I thought that, it would be, I would gain more investing via utilizing an aggressive portfolio.
That's true. Over time, that's usually what should happen. The problem is that it also brings the opportunity for it to lose more than most portfolios would do in difficult times. So you get the corresponding negative side of that too. And again, I hate to give you this answer. I really want to be able to help you on it, but it depends on what you need the money for. If you don't think you need the money for the next 5 or 10 years, you could write it out and evaluate it year by year. If you need the money now and you need to spend it, you're going to see your money eroding away, and it worries you. You've got to rethink that allocation. Maybe you do back off, but backing off means that you're selling, and you're selling when it's low. And that's the difficult part, is once you sell after we've seen the market losses that we have, you then realize those market losses. It's real. You can't get it back in that particular account. It's realized. So it always goes back to, what do you need the money for? And I would say that, if not knowing very much about your own personal situation, but if the money is not needed for 5 to 10 years, and in that period of time it's really not needed heavily after that, then having an aggressive portfolio is not a bad idea.
Okay, well, yeah, well, I can afford to, I can afford to actually let it sit there and be there, because I know, when you're doing different things like this, and then even investing, buying stock or whatever it may be, you actually are buying shares. So with regards to the way the money part look at it, like you said, you're looking at the money, but then you actually acquiring shares. So it's best to just ride it out and not sell, and not, sell, it's not the time to sell now. Like you said, the time now would be to buy.
That's right.
Thank you.
Yeah, Macy's is having a sale. Very good point.
I have a question. Hello?
Yes, we hear you.
Yes, my name is Charlene, and I was always told that you don't put all your eggs in one basket. So I spread mine out over ultra conservative bonds. I didn't put everything in one particular category. I just spread them out. And there were times when I had losses, and then there was times I had gains. But when I retired, I just left it there. So occasionally I'll go in and move things around, but I've not added any more money to it. I've just moved it around to the different categories, whether it be ultra or bonds or conservative. And sometimes it goes up and sometimes it goes down, but I don't put it all into one category. That was my point. I spread it around.
Good point. Very good point. Yes. Thanks for sharing.
Okay, I have a question too. I don't need my money now, but I had mine in several different accounts, but I was losing so much money, it just scared me. So I put all my money in the stable. So what I wanted to know is, how can I tell when the market is more stable than it is now? Because now you have one day it's up and then 5 days it's in the red. So how can you tell when it's and I know it's not scientific, but how can you tell when is the better time to move it back to an aggressive?
If I could give you those answers exactly, I'm 58 years old. I've been doing this 35 years. And I can tell you that if I knew that answer, I wouldn't be doing this today. The hard part is that by the time you feel comfortable getting back in, you've already had the best days. You see, there's these stats. I've got it in different charts that I've hijacked from these various investment companies. Your best defense, if you don't need the money, is just riding it out. Because what happens is, if, for example, you miss your best trading days, the best days that they go up, there's only about, in a 10-year period of time, there may be only 40 days, 20 days, 30 days that really make the difference in your account. And if you're not there in a 10-year period of time, 20, 30, 40 days is not many days. And if you miss those days, you missed your best opportunity to realize the full gain back of that account. So you've already sold. The question would be just going back. I mean, the answer might be just going back and reevaluating what's the money for. If you can't stomach to see that, those ups and those downs, then maybe a very, very conservative portfolio that you have a lot of your money still in the stable value fund, and you put a smaller amount in a more conservative account. Or what a lot of people will do is they'll leave their money in the stable value account, and then whatever it earns in the stable value account, they move it over to the investment account. So they let the gain go to risk. Or some people will be in the stable value fund, and then they'll do what's called dollar cost averaging back in. They'll start to buy back in, but over a period of time. So every month they'll move a portion over the next year or 2 years into maybe a more conservative portfolio. All those are just strategies. I don't know which one would be best for you, but to answer your question, there is no way of knowing. Your best defense is staying in and riding it out. But if you can't stomach it, then we got to come up with a plan B, and it may be that yeah. So, and I don't know what that plan B would be for you particularly, but I don't know if you have an advisor you're working with, or maybe you could go to the Voya folks at there that are in LA, not the folks that are on the line. You can call the ones that sit there and ask them. They might help you with a nice portfolio strategy for going to the future now that you've made the adjustments.
Okay, thank you.
I'm sorry, I don't have an answer for you.
Well, I know
I
know it's not a scientific answer, so I just wanted an idea.
You gotta
But
be there on
thank
that
you.
day when you turn around. Yeah.
We have a question from Tanya, and then we have another question in the chat.
Okay, hi, this is Tanya. My question is, I'm like Charlene, I had my money spread it out in my portfolio. So I didn't lose too much during this downfall, but my question is, I heard you say that in your deferred comp, you can leave your money in, but I thought the age was at 65 that you can take it and invest in like an IRA, or you can leave it in there. So I'm not sure if I should pull it out now, because you also mentioned the age 67. So now, did it change from 65 to 67?
No, I think we're confusing is Social Security income versus deferred comp income, two different things.
Oh, okay. All right, and
Deferred
then my other question was, it was too late for me to get into the Roth, because I would have jumped into the Roth. I had already retired, and I had already turned 50. I think I was 60. So everything was just too late for me to invest.
Okay.
So where can I go from here? That's my question. When I don't want to leave the money in there to get penalized, but I'm going to have to take the money and put it somewhere. And I'm not sure what to do with that money.
Okay. Are you talking about money coming from your deferred compensation
Deferred
plan
comp.
when you hit? Okay. So two things. Just want to clarify. Going back to Social Security, your Social Security age may have been 65. That's just the full retirement age. It's based on your date of birth. So your Social Security, the full retirement age might have been 65. Mine is 67. So they did move that up over time. So that's one issue. The other one is but that 65 or 67 doesn't affect your deferred comp at all. Doesn't have anything to do with your deferred comp. So, but your deferred comp now, you may have to, when you hit 72, you're gonna have to start taking out your required minimum distributions, and then you pay the tax on it. And what do you do with that money? And I'm gonna tell you that you can spend it, and on your lifestyle, you can save it if you like, or you can invest it, or a combination of the two or the three. You can spend some of it, put some of it in a savings account, and you can even come up with an investment account. If you have grandkids, maybe you can open up and put money away into an education fund for them, maybe looking at a 529 plan for them to help pay for their education out in the future. You could put away into an investment account for you if you don't need the money, and let it grow and grow and grow over the years that we're left on this earth. And then when you're gone, you could leave it to people that you want to leave it to in certain amounts. So you've got a lot of choices. There's nothing that you have to do. It's kind of like being a one-eyed dog in a meat market. There's so many choices. What do I do? So I think it'll come down to how much money you would take out, and do you want to increase your lifestyle and do a few more things? And if there's anything left over, then that choice would be, do I put it in a savings account to keep it safe? Do I invest it? Do I do something for my grandkids? Very common popular suggestion is to help invest into grandkids' educations, and there's ways to do that. So you've got many choices in front of you, which is nice.
Okay. Thank you.
You're welcome. And then I see the one here. Once in the deferred is in the post-tax. Are you not required to start withdrawing at age 72? You know what stinks, and I don't know why this exists. In your deferred comp, if you use the Roth deferred comp, the rules are there is an age 60 or age 72 minimum withdrawal. If you transfer your money from the Roth deferred comp to a Roth IRA, you won't pay the tax on it. You've got to keep it in there 5 years before you touch it. But there is no required minimum distribution from the Roth then, from the IRA. But there will be a required minimum distribution from the Roth deferred comp. And I'm not quite sure why that rule exists that way, but that's the way it is. So very good question, good catch. And I guess owner is the name on that one. So very good question.
With that, I believe that concludes the end of our part one.